you, like many people who cover tech on the street, are looking at valuations. There has been some level of hand-wringing about the big run-up that we've seen in tech and whether it can continue. What do you see when you're looking at valuations right now?
Right. So tech's been a terrific sector for the last 4.5 years for the market. But when we go back and look at 2014 to 2017, what we found was that tech just had better earnings growth. And it didn't become more expensive, it just had better earnings growth, and that's why the stocks outperformed. When we look this year, in part largely because of tax reform, tech earnings have actually been slightly below the overall market, but tech has still done very well. It's still outperformed. And the reason it's outperformed is it's gotten more expensive. And that's particularly the case with high growth, high valuation tech stocks. So that's what we've seen, and it's a bit of a deviation from what we've seen in the last 4 years, and that makes us incrementally a little bit more cautious around tech because prices can't go up forever.
How much have FANGs factored into that getting more expensive?
It's been broad-based. So last year we actually saw contribution from FANGs, but FANGs have been really strong contributors. Netflix has done extremely well this year. Obviously Amazon has as well, but their earnings growth has been spectacular. So FANGs have not gotten more expensive per se. We've seen valuations rise across the tech sector and not be driven by a select handful of stocks.
It's driven by a number of things, clearly, but we've had the discussion on a number of occasions here about the ongoing growth versus value and the outperformance that we've seen from growth. And we had one guest say to us, actually, value investors are now looking at buying into tech stocks and are getting involved. So you've got people just buying the momentum trade here as far as tech's concerned. So particularly when, and we just had a conversation earlier with Morgan Stanley saying actually they're increasing their overweight in utilities, and you see that kind of rotation to late cycle classic trades. How vulnerable then does technology look in light of the valuation concerns?
It's a really tricky call because what we've observed is that the growth versus value trade in tech has been the strongest in favor of growth in any half year in the last 15 years. So we've had growth tech outperform, so the most expensive tech stocks outperform the least expensive tech stocks by 39% year to date on a cap-weighted basis and 21% on an equal-weighted basis. So we've had, the whole market has moved towards growth, but it's been really, really pronounced in the tech sector. And it's difficult to say. I mean, we advocate kind of a balanced approach of both inexpensive and expensive technology stocks. Historically, stocks at the ends of the spectrum have done well. Stocks with middling valuations actually haven't done well historically in technology. So we're still advocating a balanced barbell.
It's interesting listening to what you're saying because it feels like one of the things that we've seen lately, and maybe in the last month or two, has been this incredible spreading out of the number of stocks people are talking about. So FANGs have been persistent, but suddenly all these recent IPOs every day just flying, or, you know, the Squares and Shopify's and Wayfair's and DocuSigns and just all these other companies that people weren't talking about 6 months ago, shooting up 30-40% in a matter of months. Is this a sign? Is this like part of that exuberance that's like, okay, people are just dashing for anything?
Look, I'm a little torn on that because, yes, we are seeing continued momentum in growth stocks, which tend to be more expensive. But at the same time, in a rising rate environment, it's typically those stocks that do well. So on one hand, we're a little bit nervous that valuations are extending. On the other hand, historically, late cycle, lower dividend paying, higher growth stocks tend to work. And so I'm a little, my bias would be to add selectively on the value side rather than on the growth side, but there's certainly rationale for why this behavior is happening.
So give us some names if you could, if you're looking at the balanced barbell.
Right.
What's on either side?
Well, look, I mean, on the highest multiple stocks, you know, you have the Googles and the Amazons of the world, which have not had multiple expansion year to date. We've seen that in Netflix, but those stocks have not gotten more expensive. Earnings have outgrown their valuations. On the sort of value side of the equation, one of the names that we like a lot and cover directly is Hewlett-Packard Inc. It's a printer and PC company. It has about a 10% free cash flow yield. Stock's done reasonably well year to date, but we still think that represents attractive value. So that'd be a name we'd be looking to add on the value side.
about as unsexy as it comes when it comes to tech these days, printer ink. But I guess that's how you find opportunities.
Oh, I mean, again, you're not chasing, that's a value name. It's not going to grow very well, but at a 10% free cash flow yield, if you're looking to add for names that are less expensive, we like that name.